All right. So, Priyanka, thank you so much for joining for financial audits. Um, it's really good to have you here, actually. I know we've had to rearrange a couple of times because I've been ill. So, can you just give kind of like an introduction to you? What is it that you do? Why are you taking part in this process? What do you hope to get out of it?
Sure, absolutely. So my name is Priyanka. I'm 30. I'm going on 31 this year. I'm a project manager within the NHS, and what I'd like to get out of it is really kind of delve deep into my finances, check how I'm doing, and really I haven't had a point of comparison so far, so it'd be really good to kind of check the health of my finances.
Okay. Are there any specific things that kind of are on your radar of things that you want to address specifically?
Definitely. I think when I initially kind of assessed and looked through everything that was outgoing, um, I noticed that I really didn't have any kind of life insurance or income protection. It's not
Hmm.
something I really thought about in my 20s. I'm now starting my 30s, and it's definitely something that's at the back of my mind. So, definitely, kind of any advice or support
Okay.
regarding income protection would be fantastic.
Okay. Cool. Anything else?
Anything else? I think in terms of pensions as well, but really I think it'd be nice to just have a health check on my finances.
Perfect.
Um, yeah.
Okay. So as part of the process, you you've done a few exercises,
Mhm.
and one that stuck out to me, having read through all of the fact find information that you provided, was your finance will. So I don't know whether or not you remember kind of your rough scores across the finance will. So there are kind of like six sections. So you had savings, retirement, investing, credit, debit, and budgeting. Do you remember your scores that you gave yourself?
No, I don't.
Okay, let me just relay them to you. And I'm really, really fascinated with this because I'm interested to see your reasoning behind each of the
Mm,
scores.
mm,
Because when I look at the fact find,
mhm.
I'm struggling to see why you scored yourself low in some of these areas. All
Okay.
right. So on savings, you gave yourself a 3 out of 10. And then in retirement, investing, credit, debit, and budgeting, you gave yourself a 1 out of 10 in all of them.
Mm.
Any particular reason why that is?
Um, just because I think I've really been guided by what's out there on the internet. It hasn't really
Okay.
come from, it's felt like it hasn't really come from a reliable or trusted source. And I've really been kind of guided by all of the information that's out there, everything that's on like trending or doing well. It really hasn't come from somebody that I feel like I can trust, and for me to really have that point of comparison, or you know, that belief that yes, this is kind of the right path that I'm going on. So I think that's where it's come from. It's having that lack of confidence in those particular
Okay.
areas.
Okay. That's common. That makes sense. That makes sense because, like I said, in your fact find, we'll go through kind of like your income and your expenditure at the moment. You're in a really good position. And if I were to score you based on what I've seen, budgeting would not be a 1. Definitely not. I mean, I'll probably give you at least a 5 or a 6 in that. You don't have any debt, so I'd give you probably like an 8 or a 9 there. Credit depends how we look at this, whether it's credit score or kind of like credit usage. If it's credit usage, again, you've got 0 debt, so probably an 8 or a 9 there. I know you haven't got any investments at the moment as shown,
Mm,
but you do have a pension with work. So
I do,
I
yeah.
probably wouldn't score you 1 out of 10 there either. I'd probably give you, probably a 4 or a 5 out of that. And the fact that you've got one of the gold plated pensions as well, I'll probably give you a little bit of a higher point. So I think when
That's
we
good
touch
to
on
hear.
all of these, I think you'll find that you're doing maybe a little bit better than what you think you're doing in the grand scheme of things. But I get what you're saying. There's a lot of noise out there at the moment,
Mm,
and it's very, very hard to know what to listen to and what to kind of ignore. And that's the danger of social media, really, to be honest.
exactly, exactly. And, you know, like I said, I think in our culture, money's not really a conversation that's talked about. It's not a discussion that I had growing up with parents, even with friends. It's something that's very much kind of kept within, and something that's not really, yeah, I mean, it's not considered a healthy conversation to have.
Hmm. Okay, that makes sense. 100%, I get it. All right, so just tell me a little bit about your income at the moment. I think your net take home is about 3,000 roughly per month.
That's right.
And I've got on the fact find here that your expenses are about 1,530, which means you have a disposable income of 1,500 a month roughly.
Yeah.
Is what I've got from the fact find. How do you feel about that as kind of like a ratio of your income and your expenses? Because a lot of people that I will speak to won't have disposable income, or they'll have very little disposable income because of costs.
I think it's okay in terms of it being kind of 50-50. Ideally, I'd like to save more or find a means of passive income. But yeah, I mean, it's the most that I've ever earned kind of in my life. And yeah, I mean, I don't know. It feels like I'm in a good place, but I have had to make kind of compromises to kind of get to that place. You know, I'm living at home with my parents at the moment, so I'm saving on rent there. But obviously, in the future, I'd like to build a family. I'd like to get married, and of course, at that stage, I know my expenditure would go up. So yeah, there is, I guess, a little bit of nervousness when I think about the future.
Which is natural. So how far ahead do you think moving out would be in the future for you? Or what does that look like in your mind?
Perhaps I'd say in the next 2 or 3 years.
Okay. So that will be 2024, 2027 roughly. You're looking about that period of time. And what does that look like when you get to moving out? Are you going to be looking at buying a property potentially? What's generally the plan, do you think?
Potentially the plan would be to look at buying a property. So I'd probably be looking at a 2-bedroom house closer to London, because my home office is in London. Not my home office, sorry, my work office is in London. So definitely closer to London. But yeah, I'd be looking at kind of a 2-bedroom house.
Okay. So that's something that is worthwhile just earmarking too. Because I think one of the things that I found to be really, really useful is having something that gives you kind of something to work towards, particularly when it comes to disposable income.
Yeah.
Because I think sometimes if you haven't got an outlet for disposable income, and I'll talk from my own experience, what I ended up doing is spend it on just like stuff. And then all of a sudden it's like, hang on, I'm earning really good money, but I've got absolutely nothing to show for it. So putting something in the near future to say, okay, I want to work towards this, allows you to look at that disposable income and say, okay, I'm going to take part of it and put it towards that. And you get a satisfaction that you're actually moving towards something specific that is going to further you kind of like in 2, 3, maybe 4 years time, and in 3 years time for yourself. So that is something that is perhaps worthwhile expanding on in a moment with you as well. Okay.
I love that advice. Thank you.
Yeah. In terms of just general finances, so one thing that I did pick up here, and I think it's worthwhile just talking about, is obviously you've got a bit of an emergency fund right now, which is good. How do you feel about that?
I feel good, yeah. No, I don't know. I think it's that lack of confidence that you just think everything's okay, and I don't know. It's just there's a lot of anxiety that I feel when it comes to money. I'm not quite sure where that stems from, but that's fine. Yeah.
What kind of anxiety? When you say anxiety, is it anxiety of not being able to purchase something or afford something, or just not having enough there? What kind of anxiety is it?
Definitely not having enough there. You know, I when I think about kind of my parents, I'm from a working class immigrant family, and my parents really kind of built their wealth. They didn't come from generational wealth. They didn't have kind of a safety net per se to fall on. So I guess it's that sense of not having a safety net. But then also I was diagnosed with Crohn's disease about a year ago. So there's also, I think, a lot of anxiety around whether I'll be able to work in the future as well. Okay,
which is probably where the whole income protection perhaps comes in,
Exactly.
and maybe
yeah.
even the life insurance also comes in as well. Okay.
Mhm.
I know you used this phrase before we started recording, financial security.
Mm.
Would you say it's kind of really anxiety around financial security around that?
Yeah,
Okay.
absolutely.
Let's dive into that, because financial security will mean different things to different people.
Right.
And for some people, it will be a lump sum of money.
Mhm.
For some people, it's not that. It's just about making sure that the provision is there to cover them in a particular circumstance. So if you were to kind of like put yourself in the perfect kind of like spot, what would financial security look like for you specifically?
I think it would be a mixture of kind of what you've mentioned. So it would be having money in the bank. It would be having just the reassurance that in the event that something happens, you know, the people that I'm closest to are okay, and they're not having to bear the brunt of, you know, if something, in the case that something happens to me. And then I think it also comes down to assets as well. Having assets that I can depend on or lean on should something happen. There's an element of security that comes
that
around.
provision. It's that provision, effectively. Okay, cool.
Yeah.
So back to the first thing you mentioned, money in a bank. Is there a number to it? It's a difficult question.
It is a difficult question, yeah. 100,000 comes to mind.
Okay. Any particular reason around that? Why that number exactly?
There's no. I think that's what I was kind of working towards in terms of kind of my saving goals to reach that first 100k.
Cool. All right, that's good to know, because I think again it's about provision, and for some people it's about cash, and knowing that the money is there that you can fall back on if you really, really, really needed to access that kind of money. So what I would kind of like to kind of explore a bit as we go through this is, how do we start to escalate towards that? What are the vehicles in which to do it? Because you've mentioned assets there as well. There is an argument to say, there are different methods you can use, but there is an argument to say that you could probably acquire assets that will equal that amount quicker than you could actually save that amount. So there's maybe that kind of approach to also have a look at. But when you say assets, what kind of assets are you talking about? Are you talking property or what? Property,
yeah. So that's kind of how my parents built their wealth, was through property investment. So yeah, that's kind of what I've known. Yeah.
Good. All right. So you'll be on the way to that in 2027, obviously, with potential property there. And I think if we were to try and put a date on, you know, this financial security number, how far into the future would you say that would be? So you could have assets and 100k in cash.
Yeah.
At what point in the future, where would that be?
I'd like to say within 5 years to get to that 100k goal.
Okay.
And that's, I think, if I think about things like passive income, other streams of income, whether, you know, if with the property that I'm in, which is my parents, if a lot of kind of where I am and my plans ride on a lot of their decisions as well. So my parents are in their 60s, they'll be retiring in a few years, where they decide to retire abroad, which would mean that this property would be vacant, and whether I'd be able to kind of generate rent from this property, or whether I actually decide to sell this property. So it depends on, a lot of my decisions depend on kind of making sure that my parents are okay, and you know, they've got their kind of financial arrangements sorted, and they're on their way to retirement. So that is another big goal of mine, to kind of retire my parents, I think.
Okay, cool. That's good. All right, so 5 years in here, if we were to put, because I think property is one thing that I think is worthwhile definitely having a look at. And I think if you're looking at for financial security, property can provide a little bit of that, especially if you're going down the route of maybe using it as a means to generate an income, potentially. So investment properties, buy-to-lets, those type of things potentially help you actually get there. The question will be, right, how do we actually plan towards achieving some of that within a period of time so you actually move closer to that specific goal moving forward? Now, the good thing is you do have disposable income. So again, it's going to be utilization of the disposable income to try and help you move closer to that goal over the course of time. Now, whether 5 years you'll be able to do it within 5 years, that would completely depend on a number of factors. Is the contribution rate going to be large enough? And if you do go by contribution rates, what kind of strategy do you actually go down? Because I think to save £100,000 over the course of 5 years, you need to be saving 20 grand roughly per year with just pure contributions in there. Right. You can have a look at investing. Investing, though, can be a little bit rocky. You can go up and down. So the rate of return you would need to generate would be relatively high to be able to get to £100,000 unless you went to something that was really kind of like maybe speculative, like maybe a Bitcoin, Ethereum, or crypto that does extremely well, which we have no control over whatsoever. And I think these are the challenges that people face these days, in the fact that how do you go about creating this kind of stuff without taking too much of a gamble and a risk that is outside of your realm of control, if that makes sense.
That makes a lot of sense. Yeah.
So I think, talk to me about disposable income that you have at the moment. Does it go anywhere specific, or what do you do with it?
So would this be kind of when I get my salary and then I take away my expenses? Would that be kind of the disposable income? Okay. Yeah. Like you said, there's not anything particular. I think sometimes you get kind of the emergency bills that come up. Some of the money goes towards kind of renovating the current house that we're living in. But there isn't really, it doesn't really go. If there's something that comes up as an emergency, it will go towards that. But besides that, there isn't really anywhere that it kind of has a place to go to. I'd say,
Okay. And I think one thing that we can do together today is maybe provide a little bit of structure around it. So, in other words, earmarking. If you got 1,500 quid as disposable income, earmarking a certain amount of that within the realms of reality towards, we want to build some financial security, or at least move closer towards building financial security within a period of time. So when you say that, one-off costs, emergency costs, roughly, if you had the 1,500 right now on a typical month, after emergency stuff, things that are unexpected, one-off costs here and there, how much of it would you say you would have left over at the end of the month after kind of other bits and pieces have actually gone?
So I've kind of created a habit to put some money into my savings first. So if it was the 1,500 and say this is a typical month, I'd probably be looking to put around kind of the 500 to 800. This is after bills, so it'd be around kind of 500 to £600-700 into savings, perhaps even more if I can. And that's because I think my expenses at the moment are relatively low. But again, it's things that you can't even. There's things that come up that I can't even.
That are just unforeseen.
It's just I had to buy my dad's flight tickets the other day, and that's something that I really wanted to do, and that was around £800-900. And for me, that's a really big thing, and being able to buy things or give back to my parents, which is what they kind of did to me growing up. So there is that part of buying things for mum and dad as and when things occur. I mean, you've got a vet bill that comes up, you've got a dog with an ear infection. So there's things that are kind of outside of your control. So I like to keep a bit of money for that, but I try and make a habit of, with my disposable income, putting some of that money into my savings first, and really being kind of really disciplined with that.
Yeah. Okay, so would you say you've got a structure around that specifically right now?
No, absolutely not.
Okay. So that's what I think you would really, really benefit from, is having a structure around it. And when I say that, it's, things are going to pop up all the time that you're probably not accounted for, and that's completely fine. But I think you're in a position where you have good disposable income to be able to make provisions for all of those things. What I'm trying to say here is, if it is likely, for example, that there might be something you want to pay for your parents, account for that. So give yourself a bit every single month that goes into, maybe, who do you bank with?
I bank with NatWest, Nationwide.
Okay. Some of the providers, I don't know whether NatWest or Nationwide actually do this within the app now. You can create spaces within the app. So what you would do is you would create a space specifically for things. So you might have a mum and dad pot, and every single month you'll say, okay, I'm going to allocate maybe 150, 200 pounds for a mum and dad thing.
Yeah.
And that money goes into that space within your account. And what it does, it allows you to start to compartmentalize each facet of your expenses. So in other words, if you've got, 1,500 quid left over, and you're going to be having between 500 or 700 quid in a savings account, you create a space specifically for that 500 to 700 quid. And when that's gone, you've got anywhere between 1,000 and maybe 700 quid, 800 quid roughly, that you've got for all these other things. The idea here is, if you can provide a little bit of structure around it, bearing in mind that there are other things that you would need to pay for, having that savings account specifically, which is for this financial security goal, right? That's going to give you a feel-good factor in terms of, you've got something there, but you're not also neglecting the other things that you want to be able to do for mum and dad, and maybe even for the things that you might actually want to do, like holidays and stuff like that yourself.
Yeah.
Does that make sense?
That makes a lot of sense. It does. Yeah. No, thank you. That makes a lot of sense.
So I think that's worthwhile doing. One of the best ways you can do that is actually to automate it. So again, I don't know what it's like with NatWest or Nationwide, but what you can do is you can do things like standing orders or something, where you just do something where on payday you automatically know, right, you're going to transfer this to this account, and you'll get this psychological boost in the fact that you'll see that the money will go in there, and as the money grows, you'll get the really good feel good factor. Because I think if we have a look at, your first goal, which is if you're moving out in 2 years' time, in 2027, the biggest question is going to be is what deposit are you going to need to be able to have for that purchase, for that property? And I think when you tally up all of the numbers, if you're doing something between 500 and 700 quid, which is really, really good, over the course of 2 years, let's just go 500 quid, you're looking at £12,000 potentially there. You would still be able to have a lifetime ISA. So within that £12,000, you can get £4,000 in the lifetime ISA, £1,000 free from the government. You'll be able to make quite a good momentum towards a house deposit just by doing this very, very simple thing. And that's if you just did 500 quid. If you did 700 quid, well, that's 8,400. Yeah. 8,400. You times that by 2, and you're looking at 16,800. Whack another £2,000 on top because of the lifetime ISA bonuses. You're looking at 18,800. That right there potentially becomes a really good deposit for potentially moving out in 2027. Does that make sense?
Yeah, no, it does. So yeah, I think I could say this on the recording. So I can't use a lifetime ISA because with the property that I purchased now, it's got my. I don't think I can, but I mean, you can correct me if I'm wrong. Yeah. The
property, you're named on the mortgage, aren't you?
It is. It's on the mortgage, yeah.
Yeah, that will take you out because you won't be a first-time buyer per se. Although I have known people to work around it. So I had a neighbor who bought, actually no, he was using the Help to Buy, which is no longer available. He used the Help to Buy scheme and he was able to use it twice. Sold the old house, used it for the second house. So yeah, lifetime ISA, because if you're named on a mortgage currently, you wouldn't be classed as a first time buyer. So unfortunately, you'd lose that £2,000 potentially you would get from the government to help along. But it still puts in motion the ability for you to really put some money aside towards a deposit. I mean, do you know roughly where you would be if you're saying closer to London? Whereabouts exactly do you think?
I can't really say at the moment. And I think I'm open to renting as well, if by within kind of 2 or 3 years. Because I think for me, the biggest thing with getting a mortgage is having somebody to get the mortgage with. And I think at that point, if I'm not in a relationship, if I'm not married, then it would mean it's quite scary, but potentially buying property on my own. So there's a lot of kind of variables when I think about that. So yeah, I mean, within 2 years, I think, I'd be open to renting if I'm not financially able to buy a property.
Yeah, and I think thinking ahead of time to, if you are going to buy, thinking ahead of time to the kind of locations that you're potentially buying is important, because what you want to know is if you're looking at a 1-bed or 2-bedroom flat, what's the going price for a 1 and a 2-bedroom flat in that area, because it will really help you plan. I had a session this morning where we were looking at someone who potentially wants to move out of London,
right, to
get into a property, and we were looking about Milton Keynes, and when we started to have a look at the prices of properties where she would be looking at, it allows us to work back and say, okay, deposit levels would need to be here for her situation, where she only wants a mortgage where the mortgage can be no longer than 5 years. So she's going to have a much, much larger deposit, but you can start to play around with the numbers. So trying to get a head start on that and think about it, even if you're just looking at it from a very cursory point of view to start off with, just get an indication, if it's here, this is the average cost. And for a deposit, you probably want anywhere between, really 10% is probably the sweet spot. So if it's £200,000, you need £20,000 roughly as a deposit. That's a good way to have a look at it, to kind of, get your head in the game a little bit there.
That makes a lot of sense. Thank you.
Yeah, cool.
Yeah.
You're not currently investing or anything, are you?
I'm investing in the sense that I have an investment account with, gives me NatWest. So yeah, it's an investment manager, I'm assuming, that does kind of your investments for you.
Why NatWest? Is it purely because you bank with them?
Well, to be honest, I think I can say this on recording. I initially was banking with Barclays, and I remember having a conversation with somebody from the branch, and me saying, I want to invest 10,000, and they kind of came back to me and said, well, you need a minimum investment of 20,000. So yeah, NatWest, it just seemed really easy from their website to kind of invest, little sums of money. So that was kind of the reason why I was investing with NatWest. There's the trading platform. Trading 212, I think.
212, yeah.
So there's an S&P. I'm investing bits of money.
S&P 500
as well. S&P 500
okay, cool.
And the FTSE 100 as well.
And the FTSE 100 as well. Okay, cool. That's good to know. It's interesting when people use the only reason why I asked the question around why you're using the solution with NatWest. It can be really good for convenience, but oftentimes they will have a very limited range of things that you can invest in, and you're going to be paying over the odds on fees for it as well. So it might be worthwhile just checking what you're paying in fees for them to manage it, because it is highly likely that you could probably get someone who would do the same job probably for less.
Right.
For considerably less.
Would that mean kind of going, like, who would that person be, and how would I, who?
So there's a handful that I'd probably say that would be worthwhile maybe doing a comparison with. So what NatWest will do for you is theirs will be kind of like a robo managed solution, right?
Right.
So you send them the money, they invest it, they look after it, they then report to you what's going on with your money and how it's grown or not. So in a comparison, you can have a look at the likes of people like maybe Wealthify, for example, is a good one. Money Farm would be another good one.
Right.
You could probably compare with Invest Engine have a managed portfolio service. Out of those three, Invest Engine would be the most cost-effective one.
Okay.
Out of all three. And within their managed portfolio service, I'll be very, very surprised if they didn't have something that is very similar to what you already have with NatWest,
Right.
that you could pull the money over to and pay substantially less.
Wow. I wasn't aware of this information at all. I mean, what are they called? I mean, are they investment firms? Are they trading firms?
They're investment firms. They're called robo advisors or robo investors, basically.
Right.
And the idea is, you send them the money, they manage it for you, and they look after the investment, and they will have a team of people that will be looking at it on a consistent basis to ensure that you are able to achieve the best growth possible. But like I said, with having worked for the banks, I know that they pulled out of the whole financial advisory kind of like thing back in 2007, 2008, and some of the offers that they'll have right now will be very, very kind of like limited compared to the likes of others, where it will have more, maybe a little bit more variety and maybe a bit more of a wider choice for you to move into. Although sometimes if you're looking at the likes of, for example, Wealthify and maybe even Money Farm, they will build a portfolio which they feel will suit your circumstances, your risk profile. It's worthwhile comparing just to see, because I think for you, it is going to be about what you're paying in fees. It could be that, you know what, they're not that bad in terms of the fees. I've not looked at them recently, but it could be that you might be paying 1.5% per year for it. And if you are, that's a lot. It really, really is. So if you can get it to 1%, sub 1%, that would be amazing. And I think with some of the providers out there, you could probably even get it as low as 0.75%.
Okay.
In terms of your annual fee.
Okay. Yeah.
So definitely worthwhile looking at.
Definitely. No, thank you for that. I wasn't aware at all of these investment firms, and that being kind of an alternative to investing with banks.
I will send you kind of like a brief kind of like summary of this once we've finished, and I'll probably link a few that you can have a look at as well. And if you do have questions afterwards, then just let me know, because I can say, look, this is what this one does. Because when you're looking at the information, it can be quite confusing.
Right.
And it's annoying that it shouldn't be as confusing sometimes to understand what it is they're putting there. But if you do find yourself being confused, if you ping me and say, look, what does this mean? I can say, look, it means this, and this.
Okay, great. Thank you.
So talk to me about there's no life insurance at the moment, no income protection.
No.
So I know that you said that you haven't really thought about it up until now. Is there any particular reason why you're thinking about it now? Because on the fact find, when you were completing it, it's one of the things that jumped out, and you said that there would be a significant impact if you were to need something, one of those two, and you didn't have it in place.
No, absolutely. I think in your 20s, it's definitely not something that you think about your health. I think now I'm in a better place financially, but then also the fact that I'm dealing with an illness, and there are fears around this disease becoming progressively worse. God forbid I'm in a position where I'm not able to work, then with kind of all of those thoughts, it's definitely made me think and really think seriously about putting life insurance or income protection in place. If I'm being completely honest, I don't really know the difference between the two, or whether you take out growth, whether one's better than the other. But just being diagnosed with Crohn's disease has really kind of been a shock to the system and been a shock to my life, really. And it's made me think about what I can do better financially.
So you said you were diagnosed with that in 2022?
I was diagnosed, kind of officially diagnosed about a year ago. I've been on medication since December. And with God's graces, everything's going well. They're having to do a bit of tinkering with my medication to try and get the doses right. But my symptoms can be as bad as having really bad kind of stomach pains and feeling very fatigued, and just being really, really poorly in general. And it's a really debilitating condition. But it's being managed really well at the moment with medication. Hopefully it will get to the stage where I'm at remission or in remission. And it's scary using words like remission because you think of cancer and but no, it took me a really long time to kind of accept the condition. It wasn't something that was in the family normally. So there was a long period of time where it was about accepting that I've got this lifelong disease. But I'm at the stage now where I'm just trying to think as positively as I can about the future. And I think that's where the terms like financial security and financial health are probably stemming from.
Yeah, okay. So I'm going to ask one other question because I need to ask this in order to kind of know what was done at the point in time. So on the mortgage with your mum, you're named on that mortgage. When you took that out, did the mortgage advisor go through any life insurance or income protection, any policies at all?
No, it wasn't. I did find that quite surprising at the time, that I think, but at that time I wasn't diagnosed, and it wasn't something that was really discussed. I think with some, I don't know if I'm right and you can correct me in this, but with some mortgage lenders, there's a requirement for there to be life insurance. I think with the mortgage that we took out with Barclays, I don't think that requirement was there. So for us, it was kind of like, oh well, it's not a requirement, let's not take it out. And it wasn't really thought about. It wasn't really something that was, deliberated or really given much thought to at the time. Okay,
so the reason why I asked that is because a good mortgage advisor should have gone through life insurance, critical illness, income protection, policies that potentially would cover the mortgage payment if you were unable to work or something were to happen to you or your mum or anyone that's named on the policy. If they didn't, it's a little negligent because they should.
Wow.
They're kind of required to, really. A good mortgage advisor should have that conversation with you. And the reason why I asked the question around when is because this is a tricky situation now. Because with the way life insurance works, life insurance will basically work in regards to, so there's life insurance, there's critical illness. You can get the policies joint, so life and critical illness together, or you can have a life insurance policy and a critical illness policy separately. Most people will do them joint because oftentimes it's more cost effective to do so, right? So when you took out the mortgage, for example, if I was your mortgage advisor, I'll be talking to you immediately about life and critical illness cover. And the whole point of that is that with life insurance, it's designed to pay out on death. So if anything happens to anyone named on the mortgage, one of you to die, the life policy will pay out the sum of the outstanding balance of the mortgage, or a larger amount if you chose to choose a larger amount for your cover. So that covers you in terms of death. The critical illness element means that if you are diagnosed with a critical illness, which I believe Crohn's disease is one of them, upon diagnosis, it will pay out the amount that you elected for the cover to cover you for. So in this example, if you have £200,000 left on the mortgage, right, and that was the mortgage amount at the time, you took out a life and critical illness policy for £200,000. Upon diagnosis of a critical illness, it will pay out £200,000 that the mortgage is completely paid for.
Right.
So in a way, the fact that this mortgage advisor hasn't actually covered life, critical illness with you, it's bad. It's negligence, really, to be honest. Now, is there something you could probably do? Potentially, yes. So do you remember whether it was a Barclays mortgage advisor or an independent mortgage advisor?
Independent, I believe.
Okay. There might be things that you can do because they should have gone through critical illness and life cover. And if they, so for example, if they said to you, this life and critical illness cover, and you said, look, we're not interested, what they would have to do is get you to sign something to say, look, we offered and spoke to you about critical illness, you decided not to take the cover. That's typically how they will cover themselves, essentially.
Right.
So I granted this will be a while back, it will be worthwhile just trying to maybe refresh, have a conversation with your mum around the conversation of this. Because now that you have a diagnosis, it isn't to say that you can't get cover, but the cover is going to be a lot more expensive if it isn't excluded completely from your cover. So just as an example, I have sickle cell anemia, right, which I've had from birth. So for me, I can get life insurance, but I cannot get critical illness because of my sickle cell anemia. And I also can't get income protection because of my sickle cell anemia. Because my sickle cell anemia, I've been very, very lucky with it. But typically, for example, my brother, he was in hospital every 2 months, 2 weeks, 3 weeks at a time. So it substantially impacted his ability to work. And therefore, if you think about it from an income protection point of view, so income protection is, it will pay 70, maybe 80% of your wage. So if your take home is £3,000 roughly, let's just say it covers 75% of your wage, it will pay out £2,250 per month so that you can continue to pay your bills. Now, there are different versions where it may only pay out for an elected period, maybe a year, maybe 2. There are some policies in income protection where you can have it pay until you retire. So for a lifetime. So this is why it's have a conversation with your mum to really try and refresh your memory over what was offered to you at the point when that mortgage was taken out. Because it should have been offered to you. It should have been a conversation. If it was not a conversation, then I would say it's negligence. Because a good mortgage advisor should have that conversation with you. Now, you'll probably get life insurance. You'd have to shop around and maybe take a little bit of advice. You know, you can speak to a protection or insurance advisor. They don't charge you up front. They will make money if they find your policy that you're happy with. They'll get paid a commission. But their job would be to sit down with you and say, right, we're looking at life insurance for you or this policy for you. I'm going to go out knowing that there's a diagnosis already and we're going to see what comes back. So what they will do is they will go and search hundreds of providers, basically, and see who comes back with quotes. And then they will say, right, these are the options that are available. Now, typically what happens is if you do have a diagnosis, if when the mortgage was offered to you, say life insurance would have cost you something like £25, this is an example, with the diagnosis, if they will cover you, what the insurance companies will do is they will rate that premium. So they might rate it by 4 times. So what would have been £25 will be £100 a month.
Right, okay. Yeah.
So I'm not saying it's impossible. It could be possible. But I think you really need to speak to a protection professional who can take into consideration that you do have a diagnosis and they can go and source providers specifically in the knowledge that actually there's a diagnosis there. What could be an option is that you'll find someone who will cover you, but won't cover you for Crohn's disease specifically. That's something that I couldn't find. So for example, for me, because they say sickle cell anemia apparently it's really dangerous. I mean, I've had very few issues with it during my lifetime, but they won't even exclude it as a medical condition for critical illness for me or for income protection because it's that dangerous apparently. So you might find one that will do it as an exclusion. You might find a policy that will actually cover you for it, but it will be rated up if they do.
Yeah, no, I think I was aware of the fact. And Joe, I think, yeah, it's all very scary if I think about it really seriously. But yeah, I mean, ideally, I think I'd like protection where Crohn's disease is included. But again, like you've said, I've really got to shop around and find what's best for me and best suits my needs.
Yeah.
Again, I wasn't aware there was such a thing as a protection advisor. So that's really helpful advice.
That kind of brings us back into the whole conversation around the money in the bank and assets and how we actually go about doing that. I think we need to be a little bit prescribed around what this actually looks like, because it will be heavily dependent on your earning ability, because the capital has to come from somewhere. So you mentioned earlier that maybe your parents might want to retire in a couple of years' time. They may be moving back. What would that look like specifically? What might that look like potentially?
So if they do decide to kind of retire abroad, it would mean that this house would potentially, I mean, I've got no use for a 4-bedroom house, so it could potentially be something that is let out, and hopefully that will mean with that income and then perhaps with whatever's in my savings, and that will allow me to either buy or rent a property. And that's why I think a 2-bedroom property would be absolutely fine for me, but I've got no use for a 4-bedroom house. And that's if they come to the decision of retiring abroad, which they're kind of, I think, at 80% at the moment, 80 to 90%.
Okay. So that potentially is a good kind of scenario to potentially work with. So I think if you look at, what's the rental on a 4-bedroom house now down where you are roughly?
I'm not sure on rental. With mortgage payments, we're making about, at the moment, with the rate that we're at now, we're making, I think it's about 900.
914, I think you put down.
914, yeah.
And by the way, the rate is amazing. We need to talk about that, because I made a note to mention this as well. 914, the mortgage payment. So I think that the equation to be mindful of here is you want to be able to rent out the place for more than the mortgage, which I think you will. So actually, can I just do this right now and see if there's a way to find out how much in your neck of the woods a 4-bedroom place would actually be, because I think playing around with numbers is really important, because it gives you an indication of roughly what kind of, what's the starting point, that we're working with here. So let me just see if I can find something here. So let's go, right, so there we go. We've got a 4-bed is what we're looking at. Let's just save here. Okay, so I'm seeing here 2250 per calendar month. I'm also seeing 1850 per calendar month, 2250, 3000 per calendar month. So okay, let's just say, for example, rental, let's just go 2000 per calendar month, right? If the mortgage is 914, that's 1100 quid in profit potentially. So as a bit of income, that definitely helps you towards that. I think because of your rate, and I couldn't believe this when I read it, 1.74, that's amazing. So when that ends in October, I think you put on here that you've got something on the Bank of England base rate plus 3.54, I think it was. Where did I write this down? Where is it? Yeah, 3.49, which means that you're going to go from 1.74 to 8.74%. You definitely don't want that to happen.
I don't want that to happen at all, no.
So
it's really scary.
My advice to you is that runs out in October. You can start shopping. Where are we now? April. You can start shopping around now.
Yeah.
So start getting the feelers out there around what rates are available, what you might be able to lock into. Later on this year, from June, we're supposed to see the Bank of England base rate drop a little bit. which will mean that mortgage rates will also come down. So you may not want to lock into something right now, but May, June, once you hear the Bank of England base rate has come down, you definitely want to go to market and see what the rates are currently available for you potentially will be. Because if the bank rate drops, you'll get a better deal. And ideally, if you can get into something that's probably going to be something, I would imagine, around, what's your loan to value? Your loan to value is pretty good. 190 divided by that, 54% loan to value. You might be able to get something in the 4s, is what I would expect.
Okay.
So you won't see a massive jump in the mortgage repayment, but you'll see a jump. It might be a couple of £100. So it might take it to like 1,000, maybe 1,100, 1,200 max. Yeah. And again, that's worthwhile considering. Again, if your parents do decide that they're going to retire abroad, if it is rented out, you're able to get £2,000 a month. At £1,200, that's going to give you £800 profit, potentially as an income. So these are all things that are worthwhile bearing in mind and actually looking at when it comes into it. And I think, would your parents sell? Would there be any circumstances where your parents would sell?
No.
Holding on to property.
Their finance logic is, their finance logic is sell if there's a necessity, but rather than that, they hold on. Makes sense.
You know, if they retire abroad, you put a tenant in there. Tenant's going to be paying down the mortgage if you keep it on full repayment. I mean, the other alternative, that if you already wanted to increase your yield, is you could go interest only, but you're going to have the principal amount left over. So ideally, stay on repayment. The tenants will pay down that mortgage for you over the course of 10 years. And at one point, you're going to get to the point where the mortgage is completely gone and all of the rental income is profit for you, and the property is appreciated in value as well. So I think my big sticking point here on the plan for you is around the financial security piece. I don't have all of the answers for you on it. I think there needs to be structure around doing something with your disposable income now to make sure that you're able to kind of like build some buffer. And in 2 years' time, it may be a case that you do rent and not buy. But then in the instance of financial security, if you did buy, yes, it's scary. Yes, you're going to have a mortgage payment if you did it on your own. But if you buy it, you get to participate in property appreciation in the value of the property, which means that if push comes to shove and you needed to sell, you'll have something at the end of it. It could be 20 grand, 30 grand, 40 grand, whatever. Once the mortgage is paid off, at least you're going to walk out with a tangible amount. And if money in the bank is an important factor for you, then buying potentially is one of those things that's going to move you closer towards it rather than renting. Because if you're renting, you're going to be paying somebody else's mortgage. You're not going to have that participation in the property price increasing per se. And so I think whenever I speak to people, I always talk about ownership, trying to have some kind of ownership. So you've got, skin in the game, and the ability to ride property values is always going to be a good thing, because you're talking close to London. If it's within the M25, the M25 is pretty resilient, really, when it comes to property price fluctuations, because it's supply versus demand. If you're able to get in and lock in, that's potentially going to be a good thing. And if you did need to sell, as long as the markets are up at that point, you can walk out with a pot of money that will give you cash that will help towards this financial security that you want to be able to feel. But I think it's definitely a two-pronged thing. I think you need to have in your thinking potentially buying more than renting, and also making sure that when the savings account that you're doing, the £500 to £700 per month, trying to accumulate that into as big a pot as possible. And that might involve investing, potentially, but making sure that you're investing it in a way that allows you to keep as much of your growth as possible, where you're paying as small a fee as possible. Because the reality is, if you invest it and obviously there's risk with investing, but let's just say you do a 6% return this year. If you're paying a 1.5% fee, well, you're not actually getting 6%, you're getting 5 or 4.5%. So if you can keep the fee low, you're going to keep more of your money. It's going to help you compound your money and grow your money a lot quicker. So I think just doing that comparison, and again, I'll send you links to the ones that I mentioned, is definitely worthwhile for sure.
That makes a lot of sense. I think I'm more comfortable with the idea of investing as well. Now that I have kind of, as you say, I've got a bit of disposable income and I've got my savings as well. I'm more open to investing, and I think I've watched enough videos on various platforms to feel confident that yes, that's where my money needs to be, and there's good chances of or very high chances of me getting in terms of kind of thinking about yield, getting a good yield with that money being in an investment account as opposed to savings account. I mean, you've got Peter, I think you're probably perhaps in the same boat as me, where you grew up perhaps with parents telling you to save. Like, that was the thing. You put your money in a bank, that's where it needs to be. And investment is risky, it's scary, and don't invest. I mean, that was kind of where I came from. And so I think now, as I'm a bit older, I've done my reading, I'm more open and to the idea of investing, and I feel definitely more comfortable with it.
All right, so thank you so much for watching this episode of Financial Audits. I wanted to do a bit of an afterthought and give you an update on the situation with Priyanka. As you've learned through watching the episode, one of her key concerns was having financial security. We've spoken about, having £100,000 there. And later on, as we got through the audit, we kind of then learned that a lot of the anxiety that she's feeling in terms of not being able to have the provision and having that financial security stem from the fact that she recently had a Crohn's disease diagnosis. Now, as you learn in that section, when we spoke about life insurance specifically, Crohn's disease diagnoses can impact you getting insurances. The good news is, after we finished recording this episode, I introduced her to a friend of mine who's a financial advisor and protection advisor, and she can get life insurance, and she can actually get life insurance without the rate being rated. Now, when it comes to income protection and critical illness, it looks like she is going to be able to be covered. She's going to be insurable. We just don't know what the rates are going to be just yet, because at this point in time, some of them want to have a period where you haven't had a flare-up, for example, in order for them to cover you. And no doubt they're also going to want to see medical records. So it is an ongoing thing, but she can definitely get life cover, and we're working towards getting her critical illness and income protection as well to provide her that sense of security. This one was a little bit of a weird one for me, because I know that security was a big thing for her, but there were so many questions that we needed to answer, and so many things outside of our control that we also need to address in order to provide her with that security. And it's going to be an ongoing piece of work. I think one of the key lessons that I would like you to take home is that, sometimes when it comes to insurances, yes, they can be perceived as a waste of money. But in situations where you may be diagnosed with a medical condition that can severely impact your ability to earn a living, then things like income protection, critical illness, those insurances really come into their own. So look, if you are worried about your finances at this point in time, or you're in a situation where security is one of those things that you're really, really craving and you want to work towards, please don't ignore the role that insurances can play in helping you secure your financial future. I hope you enjoyed this episode. Thank you so much for watching. If you would like to participate, I would love to have you. Please email team@petercomlafe.com. I'll catch you in the next one.